Hi everyone, myself Prezi. Welcome to my channel Commerce Class. In this video, I'm going to discuss about net operating income approach with the help of a problem. Annual net operating income is rupees 1 lakh, average cost of capital 10%, initial debt rupees 5 lakh at 6% rate of interest. Find out value of firm and equity capitalization rate using net operating income approach. If debt capital increased from 5 lakh to 7 lakh, what will be the effect on value of firm and equity capitalization rate? Net operating income or EBIT is 1 lakh. Overall cost of capital KO is 10%. Debt capital is 5 lakh. Then interest rate is 6%. Using this information, we want to find out value of firm and equity capitalization rate or cost of equity KE using net operating income approach. Formula for calculating value of firm is net operating income divided by overall cost of capital. EBIT or EBIT divided by KO. Equity capitalization rate KE is equal to NI divided by S. NI is net income. It is also known as earnings available to equity shareholders. S is market value of equity. In some books, E is used to denote market value of equity. So both are right. E and S both can be used to denote market value of equity. Then S. Formula for calculating S is V minus D. So value is equal to net operating income divided by KO. Net operating income, it is also known as EBIT. EBIT is given in your question. It is 1 lakh and KO is 10%. So V is equal to 1 lakh divided by 10% or 0.10 and value of firm is 10 lakh. Then KE. Next step is calculation of KE. KE is equal to NI divided by S. Here NI is not given. We want to find out NI. So earnings available to equity shareholders, that is NI. Here EBIT is given, that is 1 lakh. From EBIT, we want to deduct interest, tax and preference dividend. Tax and preference dividend is not given in your question. So, deduct only interest from EBIT. Calculation of interest. Here debt capital is 5 lakh, interest rate is 6%. So interest is equal to 5 lakh into 6 by 100 and 30,000 is interest on debt capital. Then EBIT is 1 lakh, then interest is 30,000, EBIT minus interest, that is net income or earnings available to equity shareholders. So 70,000 is net income. S or E is market value of equity. So S or E is equal to V minus D. Here V is 10 lakh and D is debt capital, that is 5 lakh. So 10 lakh minus 5 lakh, S or market value of equity is 5 lakh. Then KE is equal to NI divided by S. NI is 70,000, S is 5 lakh. So 70,000 divided by 5 lakh into 100 is 14%. So value of firm is 10 lakh and KE, equity capitalization rate, is 14%. Then second part of the question. If debt capital is increased from 5 lakh to 7 lakh, what will be the effect of value of firm and KE? Formula for calculating value of firm is net operating income divided by KO. So net operating income is 1 lakh and KO is 10 percentage. So 1 lakh divided by 10 percentage, 10 lakh. Then calculation of KE. KE is equal to NI divided by S. NI is net income or earnings available to equity shareholders. So we want to deduct interest from EBIT. Here EBIT or net operating income is 1 lakh. Then interest is 6% of 7 lakh. So 7 lakh into 6 by 100. Interest is 42,000. Deduct interest from EBIT. EBIT is 1 lakh. Interest is 42,000. So 1 lakh minus 42,000. Net income is 58,000. Then S is equal to V minus D. V is 10 lakh. D is debt capital, that is 7 lakh. Here debt capital is increased from 5 lakh to 7 lakh. So D is 7 lakh. Then S is equal to 10 lakh minus 7 lakh, and S or market value of equity is 3 lakh. Then KE, equity capitalization rate, is NI divided by S. NI is 58,000. 58,000 divided by S, 3 lakh. So 58,000 divided by 3 lakh into 100, and KE is 19.3%. When debt capital was 5 lakh, value of firm is 10 lakh and KE is 14%. When debt capital increased from 5 lakh to 7 lakh, there is no change in the value of firm. Value of firm is 10 lakh. But equity capitalization rate increased from 14% to 93.3%. Increased use of debt capital in capital structure won't affect value of firm, but cost of equity or equity capitalization rate increases. According to net operating income approach, the market value of firm is not affected by capital structure changes. Here, value of firm is constant and independent of capital structure changes. The market capitalizes the value of firm, and the split of debt and equity is not important in capital structure decisions. Increased use of debt in capital structure increases risk of equity shareholders, and that increases equity capitalization rate. So the advantage of debtors offset by the increase in equity capitalization rate. In this question, there is no change in value of firm. When firm is using 5 lakh debt and 7 lakh debt, value is same and value of firm is 10 lakh. But cost of equity increased. When firm is using 5 lakh debt, cost of equity was 14%. And when firm is using 7 lakh debt, it has increased, and the cost of equity is 19.3%. So increased use of debt capital increases equity capitalization rate or KE. Hope you all understood this problem. Please check the description box for the link of capital structure theories. Please subscribe my channel and share my videos. Thanks for watching my channel. Bye.